Have you ever entered a trade right when a stock looked the most bullish, only to have the carpet pulled out from under you? You see a massive green candle, the price is soaring, and you think, this is it, the breakout is here. Then, within minutes, the price collapses, leaving a long, ugly wick behind. You didn't just experience bad luck. You fell for a visual trap. In professional trading, we don't just look at where the price is. We look at where the price failed to stay. Today, we are breaking down the shooting star and the inverted hammer. These two patterns look identical to the naked eye, but they represent two completely different psychological battles. One is a warning of trouble overhead, and the other is a bear trap that leads to massive short-covering rallies. Let's start at the top. The shooting star is a bearish reversal signal. A shooting star has a small real body at the lower end of its daily range. Above that body sits a long upper shadow, at least twice the size of the body. This name is perfect because it looks like a star blazing across the sky, leaving a trail behind. But in the market, that trail represents exhaustion. The color of the candle's body? It doesn't matter. It can be green, it can be red. What matters is the story. The market opened near its low. The bulls, the buyers, made a heroic effort to push the price to new highs, but by the end of the session, they completely lost control. The bears, the sellers, stepped in with such force that they pushed the price all the way back down to the opening range. Think about the traders who bought at the very top of that wick. They are now underwater. They are holding losing positions, and their panic is what will fuel the downward move. Here is a professional tip most beginners miss: the gap. An ideal shooting star has a real body that gaps away from the prior session's body. If you see an ascending gap, what we call a rising window, followed by a shooting star, it is a massive warning. However, if there is no gap, the signal is slightly weaker. Without a gap, I view the trend as turning less bullish rather than a guaranteed reversal. I'm much more aggressive with my shorts when I see that clear gap in price. Look at this chart. Look at sessions 1, 2, and 3. On the surface, it looks like a healthy environment. We are seeing higher highs and higher lows. But as candle charterers, we see the hidden agony. Sessions 1 and 2 have long upper shadows. Even though the price closed higher, the bulls were struggling to keep it there. This is a stock rising in agony. It's gasping for air. At session 3, we see the official shooting star. But look closely, is there a body? If the open and close are exactly the same, you aren't looking at a shooting star anymore. You're looking at a gravestone doji. The gravestone doji is the big brother of the shooting star. Because there is no real body, it means the bulls couldn't even manage a 1-cent gain by the close. It is significantly more bearish. When you see a gravestone doji after a long rally, the trouble overhead isn't just a warning, it's a red alert. What if one shooting star isn't enough to convince you? That's where confluence comes in. Imagine a chart where a shooting star appears at a certain price level. The market drops, tries to rally back a few weeks later, and then forms 3 consecutive shooting stars at that exact same level. This tells us that the bulls are hitting a brick wall. No matter how hard they try to push the price up, the market is rejecting those higher prices every single time. When you see signal after signal at the same level, it reinforces that resistance. The likelihood of a crash increases exponentially. As a disciplined trader, you must have a fail-safe. If the bulls eventually find enough volume to close the stock above the highs of those shooting star wicks, your bearish thesis is invalidated. We don't trade on ego, we trade on evidence. Now, let's flip our perspective. What happens when this exact same candle shape appears after a long downtrend? This is the inverted hammer. It has the same long upper shadow. It has the same small body at the bottom. But because it comes after a decline, it is a bullish reversal line. This is the part that confuses most people. On the inverted hammer session, the market opens low and tries to rally. The rally fails, and it closes near the lows. It looks weak, right? Wrong. This is where we talk about the trapped bears. Many short sellers see that long wick and think the downtrend is continuing. They add to their short positions. But what happens the next day? Unlike some other patterns, the inverted hammer requires bullish confirmation. The next session must open above the inverted hammer's body, or better yet, close above it. When the price moves above the inverted hammer, all those bears who shorted the failed rally the day before are now trapped. They are losing money. To exit their trades, they must buy to cover. This creates a short covering rally. The bears buying to exit, combined with new buyers, bottom pickers, entering the market, creates a powerful surge in price. The negative look of the inverted hammer was actually the setup for the trap. Let's look at this final chart example to see the inverted hammer in action. Here, we see a standard hammer generating support. It's a good sign, but the market isn't ready to move yet. The next day, an inverted hammer forms. It actually makes a new low close for the move. Most retail traders would look at this and say, the trend is down, get out. But look at the support line from the previous hammer. It's still holding. The very next session provides the golden signal, a strong green candle that closes well above the inverted hammer's body. The bears are officially trapped. The next few sessions show a vertical move upward. The descent from the previous resistance, which was marked by a bearish engulfing pattern, is officially over. The inverted hammer was the final exhaustion of the sellers before the new rally began. Before you take your next trade, I want you to run through this 5-step professional checklist. Location first. Is the candle at the top of a rally or the bottom of a fall? Context is more important than the candle itself. The shadow length. The upper wick should be at least 2 to 3 times the size of the body. The longer the wick, the bigger the rejection. Check for the gap. In a shooting star, does the body gap away from the previous candle? If yes, the signal is much more reliable. Wait for confirmation. For an inverted hammer, never buy until you see a close above the real body in the following session. Don't be the first one in. Be the one who waits for the bears to get trapped. Identify the doji. Is there a body at all? If it's a gravestone doji at the top, prepare for a much more aggressive reversal. Trading is about discipline. It's about waiting for the market to prove its next move. If you found this masterclass helpful, hit the like and subscribe button and let me know in the comments. Which pattern do you find more reliable? The shooting star or the inverted hammer? I'm dedicated to helping you master technical analysis so you can trade with confidence. If you haven't seen my video on why you're drawing support and resistance wrong, click the video on the screen now. Keep your risk to reward at 1:2. Follow the checklist, and I'll see you in the next session.